morning. You're watching the market right here on ET Now, and some consolidation is what we saw yesterday, although once again we lifted off from those quiet moves. But yes, we retraced from that 18,400 print. Having said that, it's pretty much inside, so nothing really to worry about. Metal actually led the move uptick yesterday, and that 13% up move that you saw on Adani Enterprises. IT actually sold off after 2 days of some significant strength, a slight bit of profit taking there as well. There was strength in OMCs, higher prices, however, could play spoil sport. Having said that, this morning you are seeing the first jitters of the debt ceiling on US equity markets. So the handover from US equities is a weak one, Nikunj, and the SGX Nifty is indicating a downtick of about almost 0.5%.
You know, normally with a 70-point downtick on a Nifty or a little bit of weak handover, markets would have ignored it. But in general, I guess this week's price action is not that exciting, if I may say so. In a week when Adani group of stocks have made a rara comeback, Nifty frankly has struggled, and FI buying also has been strong. So contours which should drive the markets higher. Big flip in Adani group of stocks, FI buying continues, no fresh short selling in the market, and Nifty has yet struggled to cross 18,400. At higher level, we are getting pushed down. At lower level, this market is finding little support. So I think from a market standpoint, you could see two parallel markets now. Nifty is certainly entering into a zone of consolidation, and mid and small cap stocks, they continue to rotate. And I think the rotation is clearly visible because now the rotation rally has started moving down the ladder, so to speak. So it's not that we are staring at a big reversal from a market standpoint, but I think timeout is the word which I think is evident looking at the construct of the market and the fact that we are not really reacting, acting, or there is any kind of excitement based on what is happening in terms of liquidity, Adani group of stocks, and the underlying bent of earnings season.
Yeah, and speaking of the Adani group of stocks, they were all the rage yesterday across the board. You had a lot of those stocks which recovered very smartly. In fact, something like an Adani Ports recouped the kind of losses that it had undertaken since the Hindenburg report came out. And that's some interesting data as well on your screen, how the stocks have recovered quite comfortably, and the three-session delivery data as well for the Adani group companies. So the 10 listed firms in the conglomerate all did come under, did see a lot of reprieve in trade, and that's largely on the back of the clean chit that they got from the Supreme Court panel. Not just that as well, sources indicating that Rajiv Jain's GQG has been buying into the Adani group stocks over the last few days, and Nikunj, stocks worth about $2 billion now.
There's a big buyer in the market, and I think that big buyer is something who is ready to commit to more capital to Adani group of stocks. I'm going to take the clock back before we talk about what's the way forward. If you take the clock back, look, the stock sold off because of the Hindenburg report, which raised concerns which were centered around high promoter leverage, inter-party transaction, huge debt, and the company will struggle to pay back to their lenders. All those concerns have got addressed. So really from a market standpoint, the concerns which in a sense had enveloped Adani group of stocks, that's behind us. Then there is part two. Is there, after the sell-off, are institutional investors coming back? The biggest challenge for Adani group of stocks historically had been that their shareholding pattern was not very widespread, and there were no large marquee names in terms of who'd invested in their stock. But I think GQG had silenced all the Adani critics. Now the fact that even though the stocks have seen a run-up of about 50 to 100% from the recent low, GQG is still interested, is still buying from the open market. They've increased their stake by 10%. B, they've already indicated that we would be participating in the future fundraising exercise for Adani group of stocks. Now what had happened post the Hindenburg report is that Adani group had to hunker down a lot of the future growth expansion, because in infrastructure business you need capital to grow, and when capital is not there, you will have to hunker down your growth plans. So now markets would be, in a sense should breathe a sigh of relief that a lot of the plans which were on the back seat, could they be coming back? Could the second half mark as a revival for Adani group of stocks? These are long gestation projects, port, railways, energy transition, green hydrogen, all of them, you cannot take a very short-term view. You have to take a long-term view, and that's what I think an investor should do. In the short term, what happens, look, excitement and liquidity is back, and delivery-based buying is also there. So now it's a judgment which is purely based on technicals rather than deep value. I think the deep value in some of these stocks is over. They're up 50 to 100%. But for somebody who wants to take a 3 to 5 year time view and say that, look, India is going to be strikingly different, Adani is going to play a large role in terms of how the airports would be functioning, or the ownership in ports or in green hydrogen, then they should be part of everyone's portfolio. But you got to prepare yourself for volatility. These are not very cheap stocks.
Well, that deep value was surely identified a while back. Remember, yesterday we told you GQG Partners, Rajiv Jain, has invested more in the Adani group of stocks. We spoke with him back in March when we were in the thick of all that was happening with the Adani group and the stocks were tanking. We spoke with him exclusively, asking him about what makes him so bullish about the group, and here's what he told us back then.
The fact that Adani group of stocks by traditional yardstick are expensive and that debt levels are high, as a fund manager, as an investor, what gives you the conviction that both the concerns which historically have been big concerns for Adani group of stocks, those concerns, according to you in your playbook, is something which is manageable?
See, if you look at vast majority of the assets are regulated assets. They tend to a very, very long tail. So when you can't have financial leverage along with operating leverage. These companies have very sort of predictable long-term trajectory, even if you slow down the growth. So that's the first part of it. And when you adjust for the leverage, in fact, if you look at the US utilities, and we own a bunch of them, on an average debt to EBITDA levels in US utilities, and these are some of the best of the breed, is around 6 to 7 times debt to EBITDA. If you look at the leverage here, it's around 3.5 times. But the growth capex is why the negative free cash flow kicks in. So I think they have predictable earning stream that has 20 plus year visibility. These are regulated assets, and in growth utilities they tend to have negative free cash flow. That's the norm. That's, in fact, you want to have them. You want to have them have negative free cash flow. That means because they're able to deploy capital on a longer term basis with fairly attractive returns. So the debt levels, when you look from a utility perspective, is actually on the lower side, not on the higher side. But if they lower the capex plans, which they already announced, I think it becomes a fairly attractive sort of risk reward.
All right, that's the word coming in from Rajiv Jain the last time we spoke with him. But that aside, let's also focus in on what's happening when it comes to the global markets. You did have the three major averages falling in trade, Asia as well reeling under pressure, and that's largely on the back of the latest talks with respect to the debt ceiling. It has been yet another day of no results because the House Speaker has walked out of the US Capitol building, saying that the two parties are yet to reach a deal in order to avert that first ever US default. There are more meetings that have been planned here on, and the Republican representative as well, which is one of McCarthy's chief negotiators, has suggested just hours after the meeting that the two sides have actually seen a standoff. So clearly you can see that playing out on the global markets this morning. And Nikunj, the fact that there's been a standoff and questions being raised of a potential default, that could be a little bit worrying.
No, if US defaults, then it'll not be a little bit of worrying. It will be a lot of worry, trust me. Then there would be almost like an financial, financial Armageddon. So US has never defaulted. And I was looking at data, and I think we were discussing that it's only once in the history that the US federal had shut down because they were not getting the budgets. The difference in US government shutting down because they were not getting budget versus debt ceiling default. Debt ceiling default means that the US paper does not hold any validity. So that's not going to happen. It's just that who can squeeze in a bit more and who can squeeze in a bit less. Who really wants to have that last say, so to speak, that, I am the one who is the boss. So it will sail through. But the point is that really from a market standpoint, markets would wait for that last minute negotiation, because that last minute compromise is something which markets would look forward to. That what would be that icebreaker in terms of getting the debt ceiling in terms to sail the debt ceiling. That is something which markets would be looking at. Because trust me, if the debt ceiling does not go through, we are looking at not bad, we are looking at ugly situation in financial markets.
Yeah, absolutely. Well, they will not let it fail. That seems to be the messaging, at least as of now. But let's talk about the market construct. Yesterday, we did have that 18,400 print inside, but receded a little bit in the second half from there. Let's take it across to Nooresh and Kunal and find out what they're making of the charts right now. Kunal, Nooresh, hi morning. Kunal, what is it that you're making of the market texture? Seems like we could recede a little bit more looking at the global handover at least.
Yeah, we could recede a bit more, but then again, we'll land back into that same trading range, 400, 300 points for the Nifty. So no meaningful trends emerging for the indices, and I think it also gels with the expiry view, which we were highlighting in the start of this week, that the index would remain into a range of 1% from 18,200 pivot, because that's where a huge amount of option writing has happened, and because it's the monthly series, monthly expiry, that's why not just the weekly but even the monthly expiry calls as well as puts, they hold a lot of significance. Now the other positive observation which I have also seen over the last 2 days is the rollovers. Because generally at the start of the week you tend to see the rollovers taking into effect and the skew towards the rollovers, and right now in the last 2 days specifically we've seen positive rollovers. So in fact if there is an unwinding of 2,500 contracts on the bank Nifty for the current month, there is a built up of almost 4,000 contracts in the next month, which means another 1,600 plus addition of open interest on the bank Nifty for the next month. And same is the case with the Nifty. There's reduction of 22,000 yesterday in terms of open interest, but an addition of 32,000 contracts in the next series. So that extra bit of OI addition gives a sense as well as indication that the market tilt is still bullish, still on the bullish side. Yes, we may go through a patch of consolidation, maybe a round of volatility as well, but then till the time we are confined into a trading range, I think the bias should remain on the bullish side.
Okay, bias on the bullish side. Let's find out what Nooresh is working with. And Nooresh, given the kind of handover that we've got from Wall Street, what are you working with for the frontline index and the Nifty Bank?
So overall, we are still stuck in that move wherein it is difficult for the Nifty to cross 18,450 without support coming from some of the heavyweights. So we've not seen a move in Reliance Industries or HDFC Bank, but we are starting to see at least ICICI Bank come closer to an all-time high. We saw a bounce in IT, did not see a follow-up the next day in a stronger way. So overall, the structure is still positive. The bias is still positive. Now, 18,050 was the base in the last week. Going forward, 18,200 to 18,150 is the price point where you want to be buying the dip. So overall, the trend is up. Momentum could get better once we see more clarity in terms of leadership in the large cap space, at least in the Reliance and HDFC Bank side.
Okay, that's the take coming in on the markets. Let's find out then, in light of what our experts are talking about, what their strategies are when it comes to individual stocks. So we'll be back to the range. What is it then, Kunal, that you would bet on individually?
So the first one is a ban, Tata Communication. We discussed the stock 2 days back. The stock has recovered from 1220 to 1240 approximately in the last 2 days. More importantly, over the last 5-7 days prior to that consolidation, the stock has corrected some 100 odd points from 1320 to 1200 approximately. So which means that post that correction, the stock is going through a phase of recovery. That's a good sign for the stock price trend, and it's also holding up some positive indications on many momentum indicators. So buy on Tata Communication, targets of 1300, stop loss at 1200. And second would be a ban, Bajaj Finserv. This could be an interesting play because the stock has confirmed a breakout on the daily charts of an Ichimoku pattern. This could potentially be a strong trend reversal breakout. So expecting if Bajaj Finserv opens with even a gap up of 0.5% and closes above those levels, that could really indicate a start of a new trend for the stock. So buy with a target of 1500, stop loss at 1400.
Okay, those are Kunal's recommendations, Tata Communications and Bajaj Finserv. Nooresh, what is it that you're picking out?
So first is the buy on ICICI Bank. The stock has clearly shown, say, leadership status, continues to be one of the few Nifty names which is making a new all-time high. The stock came very close to a 52-week high and an all-time high. A move beyond this should open up a move towards 1,050 levels. Momentum is strong, relative strength is strong. So a buy at current levels as well as on dips with a stop loss at 930 and a target price of 1,050 in the short term. Second is a buy on Piramal Enterprises. The stock has corrected a lot over the last 1 year, the last 1 month, 3 months. In the short term, in the last 2 weeks, the stock has given a turnaround move. In the last 2 days, we saw a breakout and sustained above that 760, 770 mark. Indicates that there could be more momentum, and we are seeing the whole space do well. So out here, a stop loss at 750 and a target price of 850.
Okay, let's take a very quick break on that note. The global handover, of course, has been weak, and the SGX Nifty as well, hinting at a 0.5% downtick. Let's see on the other side what's in store for us.
Welcome back to the market. Dixon Tech in the spotlight. It's been a pretty strong quarter and a strong outlook at that. Saurabh Gupta is the CFO of Dixon Technologies and joins us on the show to discuss the fine print. Thank you so much for taking time out. Let's begin with the numbers because they've been very strong. You sounded very bullish. What is the kind of growth that you're penciling in then for FY24 and 25 in terms of your total revenue growth?
Yeah, good morning. I don't want to give a number particular, but clearly we are looking for a very strong growth. Our existing growth in the last 5 years has been mainly on account of taking larger share of wallet from existing customers and also continuously adding customers across various verticals. And if you look at in the last couple of years, mobile has been the biggest trigger for growth. And in that particular business, we are looking for some large customer account acquisition, some largest of global brands. And we are hopeful that those operations should start from Q3, from the second half of this financial year, and that should contribute a significant portion to our growth for this financial year as well as next financial year.
Okay, fair enough. And what about your EBITDA margins? 5% is what they have come in Q4. What is going to be your outlook on margins and what will be the margin drivers?
Yes, so if you look at the Q4 is around 5%, but if you look at for the full year, it's around 4.3%, which is clearly there is an expansion of almost 70 basis points year on year. I think so we would stick to that margin guidance of 4.25 to 4.5%. Clearly, we are seeing the benefits of operating leverage kicking in most of the verticals, and some of the verticals it will kick in this financial year as well as next financial year. And also focus on backward integration and migration more and more to our own design solutions. I think so it's also helping us on that margin expansion.
Right. Sort of what I want to understand is mobile phones as a segment, because you did share quite a few developments there, the two large brands coming on board in the next few months as well. Help us understand what kind of growth are you envisaging from the mobile segment, say for FY24-25?
Yeah, so these are the largest two brands. So broadly, as of now, we closed at a mobile revenues of somewhere around 4,300 odd crores with our existing customers. So we are having a growth potential on our existing customers as well. And also this new customers potentially for the 6 months of operation this financial year should add around another 4 to 5,000 crores. So we are looking to double this revenues in this financial year, mobile revenues.
That's great. And overall as a pie, what kind of revenue mix could we expect?
Yeah, so almost 50% of our revenue should start coming from mobile revenues. Then TV vertical looks, we are looking at a 10 to 15% growth in our LED TV vertical, in a lighting vertical. Washing machine looks for a 20-25% kind of a growth this year. So all across, we are looking for a growth. And also we think the new categories of IT hardware products, the wearables and hearables, where we have a JV with both, those verticals are also looks very exciting. And we should have a decent growth in those verticals as well.
All right, and you've also spoken about looking at laptops and tablet PLI scheme. What could be the additional revenue potential for this in FY24?
Yeah, so if you recently look, government has come out with the revised IT hardware PLI scheme where the budgetary outlay has increased, the incentive amount has increased. So we are studying the contours of the scheme. Over the next 3-4 weeks, we will be applying for the revised PLI scheme. And we are also in discussion with some large global brands there. We are already manufacturing for Acer there. Our quantities are increasing with Acer month on month. So yeah, to that vertical also there's a big import substitution story in IT hardware. So let's see how does it pan out. So I'll be in a better position to share those numbers in next couple of months. But clearly that vertical also looks very promising.
As Wistron has exited the Apple India business, do you see this as a further opportunity? Are there any talks, any plans for the manufacturing of Apple products?
So clearly Apple is one of the largest brands and they're the flag bearer of the Indian mobile manufacturing story. We see that, yes, definitely, if given opportunity, we would like to participate in the Apple supply chain. We feel confident that over the next couple of years, that can be a possibility, that can be a reality for Dixon. But let's see, how does it pan out? But clearly, yes, Apple clearly wants to make India as a big manufacturing hub, not only for the big domestic market, but also for the global markets.
They not approached you yet already?
No, nothing of that sort.
Okay, great. Great speaking with you then, Saurabh. Thank you so much for highlighting what business is going to look like going forward and, of course, how the quarter went by was. That's Dixon Technologies, extremely bullish on their earnings commentary. Yesterday, too, the stock shot up, and my guess is today as well, you will see a strong reaction post the numbers. But let's move on. Let's talk about other stocks and sectors which are going to be in focus. And Reliance and BP have auctioned 6 MMSCMD of gas from the MJ field of KG-D6 block, which has largely secured by fertilizer companies and CGDs as well. Somit is here to tell us all about what this really means and how it's going to impact the stocks. Somit?
Well, if you see, Reliance Industries has completed yet another successful auction, and this time they have auctioned around 6 MMSCMD of gas from the MJ field of KG-D6 block. Now, the auction price has been settled at the JKM price, that is spot LNG prices in Asia, plus there's a premium of $0.75 per MMBTU, and the gas have been auctioned for the next 3 to 5 years. Now, if you see the current JKM prices, they stand at around $9.7 per MMBTU, and the premium charged by Reliance Industries is largely equivalent to the regasification charges of imported LNG. So the prices at which Reliance Industries is selling gas is largely at par with the international prices currently. Also, do remember that the gas coming out of the MJ field also has a price cap of as it is regulated, and the price cap stands at around $12.1 per MMBTU. Now, this gas has been largely sourced by a fertilizer company. Nearly 42% of the gas auction was secured by fertilizer companies, 28% by city gas distribution companies, 12% by GAIL, 10% by HPCL, and 8% of it was secured by GSPC, which is the promoter company of Gujarat Gas. Now, what this means, now it is positive for city gas distribution companies as they have secured gas from the domestic market, and this saves them from the volatility in the gas prices that we have been seeing in the international market. And given the fact that there's a price cap, even if prices go high in the international market, they might not get impacted because of this. Also, GSPC might give the gas that it has sourced to Gujarat Gas, which means that it would be more positive for Gujarat Gas that they'll be getting the domestic gas at cheaper prices. And for Reliance Industries, obviously higher gas output and sales mean a higher revenue. But do remember that this is the last part of the 30 MMSCMD of natural gas production from the KG-D6. Earlier, they had auctioned around 24 MMSCMD of gas, and this is the last auction done by Reliance Industries from this gas block.
Okay, thanks very much. We'll be watching out for that stock in trade today, Somit. But the other heavyweight is L&T. They had a management meet and they've reiterated their guidance for order flow as well as revenue growth. Let's take it across to Sharad, who joins in with all the key takeaways. Sharad?
Well, yes, in focus we are having L&T, and their recently concluded management meet was there, where the management has reiterated the FY24 guidance of order growth of almost, you could say, 10 to 12%, while for the revenue growth the guidance remains between 12 to 15 odd percent. Now, apart from this, also they have stated that the guidance is achievable because of pipeline and the order book, and the focus remains as the government is going ahead with the capex spending. Apart from this, they did have a concern because the guidance did factor in some orders going down from November 2023 onwards before the pre-elections. Now, apart from this, also speaking of margins, they're confident of improvement between 40 to 50 basis points after what decline was seen in the year FY23. But do remember, there is an upside for the margins if there is any claims which are recovered from the concluded contracts. Now, for the Karnataka markets as well, they have stated that the impact should be limited as Karnataka constitutes between 3 to 4% of the total order book. Now, do remember the stock itself has fallen 8% from its 2023 highs as well, but analysts are still bullish on the stock, with almost 93% of analysts as per Bloomberg are having a buy rating and a 12-month target price set at 2,545 rupees per share, which indicates a 16% upward potential.
Right, and Varun Beverages has incorporated a wholly owned subsidiary in South Africa to explore the business of manufacturing and distribution of beverages. What does it really mean for the company and shareholders? Vinny is here to tell us all about that.
So absolutely, when you just talk about it, what has happened, the wholly owned subsidiary, has been incorporated in South Africa by Varroc Beverages. They will be looking to explore manufacturing and distribution of beverages. Now, let's not forget, South Africa is a 1 billion case soft drinks market. That's around 2.5 billion net sales approximately, and that is the size of around 45 to 50% in terms of the India size as well. When you talk about the South Africa market, currently Coca-Cola is the market leader over there with 60% market share. PepsiCo just has around 1% share, negligible share in those terms, while other local brands is the remaining share what is there in the South Africa market. Now, when you look at PepsiCo, the beverage company is the bottler for PepsiCo in South Africa, and the beverage company has around 10% market share, almost entirely attributable to its in-house brands as well. For Varroc Beverages in Africa, obviously it operates in Zimbabwe, Zambia as well as Morocco. They have won awards for execution in Africa for PepsiCo as well. The management could be open to more organic and inorganic opportunities maybe in Africa as well. An acquisition of bottling operations could drive a value creation for Varroc Beverages, and Varroc Beverages has proven also a track record in terms of acquiring and expanding operations. So yes, a positive there that we could see coming in from Varroc Beverages in terms of opportunities for them as well.
All right, thanks very much for giving us all those highlights. Let's move right on then and focus in on Ashok Leyland in terms of their outlook on margins as well as their overall financials. They did miss street estimates this quarter. Meet street estimates in terms of their quarterly numbers. Shenu Agarwal is the Managing Director and CEO of Ashok Leyland and now joins us on the show. Thank you so much, Mr. Agarwal. It's been an exceptional quarter on the back of the buying factor due to the BS6 transition. But how is the demand holding currently? What is the outlook for the full year?
Yeah, we are optimistic. We are very optimistic about FY24 in all the product segments. But we think because bus is coming from a very low base after COVID, the bus demand will see the maximum growth. And a recent CRISIL report suggested roughly 30% growth in bus segment over FY23, which we also agree with. As far as MHCV trucks are concerned, the growth is expected to be 10 to 12% as per CRISIL, and that is the direction we are also thinking. So overall, we think the CV industry will grow at least 10% or more. The LCV industry may be a little bit sluggish. It will still show a growth momentum, but I think the growth could be limited to mid to high single digit.
Right. So after 2019, we're seeing your margins in double digits. How suitable is this double-digit margin number going forward for the fiscal?
Yeah, we are very, very focused at Ashok Leyland on margin expansion. And I'll give you the reason. I mean, the reason is that the CV industry is going to change in many, many ways in the future. And that all needs a lot of investments in the coming years. And we have no other option but to generate enough cash from our operations to be able to invest in this change. Quarter 4 has been very good. It has been a double-digit EBITDA quarter. And we hope that in FY24, we can maintain kind of a double-digit EBITDA trajectory for the whole year. That is our focus.
Okay, and your cash generation, that has been healthy in Q4, 2,200 odd crores of cash has been generated. What are the plans to utilize it and how are you looking to increase your capacity?
Yeah, see, we normally spend about 500 to 600 crores of capex every year. I think in FY24 also, we have earmarked roughly around 600 to 750 crores of capex. Now, most of this capex would go into product development, and most of that would be focused on alternative fuels also. In terms of capacity, we think we have enough capacity going into next 2 to 3 years. But yes, some amount of capex we would spend on debottlenecking some of the capacity as our manufacturing footprint is quite wide. So some amount of capex would be spent in manufacturing, but largely the focus is on product development. And within product development, the focus will be on alternative fuels and new tech.
How are the sales pickup in the CNG demand post price revision? What kind of launches are expected for FY24?
See, the CNG, of course, because of the recent change in the policy on CNG prices, we are expecting some uptick in demand on the CNG side. But the gap between diesel and CNG is still not good enough, right? And therefore, we don't think that with the current prices, the CNG demand would be as high as it used to be. Right, but still, I think the prices are moving in the right direction. But as you know, CNG prices are going to be determined every month now based on some index, right? And therefore, we have to wait and watch how this moves. But Ashok Leyland is fully prepared with all its CNG vehicles across the product segments.
Right. And how much order book do you currently have for Switch Mobility? And, given that it has more than 2,000 buses order book?
Yeah, I think we already have about 500 to 600 buses out in the market plying on the roads. I think our order book also is more than 2,000 buses, right? And in the future, whenever these opportunities will come, as I said, we will evaluate them both on a commercial and strategic basis, and we will see where to participate.
Right now, FY23 has seen a hike in prices of vehicles, but now that commodity prices have somewhat stabilized, what is the outlook in terms of your price hikes?
I think, like I said, I think there is a good enough realization in the entire industry that industry cannot sustain EBITDA levels of the current nature, which is like, 7, 8, 9% EBITDA is not a good EBITDA for industry. And I explained, the reason is that this industry is going to change in the future, and therefore companies have to generate a good amount of cash every year through their operations to be able to invest in these in this new future. So I think all the companies are going to be focused on better price realizations, better margins, and also reduction of their cost. So to that extent, I would say, Ashok Leyland is also very, very focused on profitable growth.
So investors have been waiting to hear about a new partner in Switch Mobility. When can we meet you in the Auto Expo? I mean, you said that FY24 are hopefully on same. Any talks ongoing currently to get any new partner?
Yeah, listen, I want to clarify that we are not in a hurry, although we are very, very open to find a right profile of a partner, which is strategic in nature. There is no hurry for us to get a partner inside Switch. Ashok Leyland, you have seen that we have ended the year in a cash surplus situation, and Ashok Leyland has enough wherewithal right now to fund Switch activities. So we are not in a hurry, and we are just waiting for the right partner.
Right, great to have you on the show, and thanks for highlighting your quarter gone by and the visibility forward as well. The SGX Nifty still settling in lower after that meek handover yesterday and a weak handover from the global cues. The SGX Nifty is indicating a bit of a downtick, about 70 odd points or so. That's okay, we still got 18,300 in sight. And yes, Asia is reeling under pressure as we speak right now. Japan is down a good over 300 points. Kospi is well lower. You've got a 225-point cut coming in for Hong Kong. And Shanghai as well is lower by about 0.6%. Rahul Shah then joins in on the show to talk about what he's making of the market right now. Rahul, the big concern, of course, is whether or not the US is going to hit the debt ceiling and what kind of domino impact it's going to have on world markets. But that aside, just wanted you to assess the micros here back home. And what have you made of the earnings so far, especially from the mid-cap end of the market?
Hi, good morning. I think when you talk about it, I think obviously the biggest rally what we've seen in India is obviously one or two major factors. One is obviously softening of the crude prices, I think, which is most important for us, and I think we've seen that which are interlinked, all the three things, be it inflation, be it your the GDP, or be it in terms of how your CAD numbers would be. So I think all these three things are interlinked. So if I look at that perspective, the softer crude prices for India augurs very well. And if we see that in last 4 or 5 months, 2-3 things have changed dramatically. One, obviously the cooling of commodity price, which has helped in obviously in a scenario where and when we meet the RBI, we see the RBI policy in June, where I think the interest rate should be a status quo. So I think this all thing as are interlinked. Now we talk about the earnings seasons. I think so far, I think whatever the numbers have come out in a Nifty universe, what we feel is I think by and large, as per expectation or better than expectations, except for the metals where we see the numbers have been a little bit softer, which was as per expected. Now, if we segregate there into the banking leading all the way, we've been discussing it, and I think that is seen in the performance also in the most of the financials stocks as well. So I feel that I think a mixed quarter by technology. However, technology we've seen come back in a couple of mid-cap stocks hitting 52-week high. So I feel that again a mixed bag. I think still dragged by the large cap IT names, which still have not performed, which vis-a-vis the mid caps have performed. But we feel that I think the for clients with a horizon of more than 1.5 year view, that I think IT will play out very well from here. Thirdly, I think autos had a good set of numbers. If you look at it, I think the numbers were better than what we were expecting in this thing. So, and fourthly, I think when we talk about the consumer discretionary spending, which was visible in most of the management's commentary in this quarter. So, what we feel is, I think all these macros are favoring. And I think large caps have already done well. Nifty trades at 18 times FI25, so I think which is a fairly discount to the premium what we had used to trade. And most importantly, when we see that Adani saga is almost as getting into an end, I think when we started in Jan and we saw the turmoil in the markets, and again, which is getting now somewhere which is getting settled, what the stock prices are indicating. So I feel all these things are favoring. I feel that risk versus reward is quite favorable. Stay invested or get into numbers. Secondly, I think when you talk about the mid caps, I think mid caps also, by and large, select pockets have done well and stocks have done well. So I think still a lot of room for large and large cap stocks to do well from here. So that's what I feel at from here.
It's an all-round view on the market. Stay with us, Rahul. We'll come right back. Time for stocks on the editor's radar then. And let's begin by talking about Dixon Tech in greater detail. After their numbers, we also spoke with the management who was talking about, Nikunj, how mobile revenue is going to really shoot up and there's a lot of opportunity. How do we compare Dixon Tech to some of the other manufacturers?
Avan, 2 years ago, what happens to defense manufacturing, 6 months ago, a year ago, what happened with railway manufacturing, I think next 1 year will happen with electronic manufacturing. They are talking about aggressive growth in FY24, and it's a very, it's a low margin but a high turnover business. They did have a cyclicality in the business, and markets thought that the business is not linear, it is a cyclical business, but they are talking about that growth is actually making a comeback. Now, why do we have Dixon back? Because if you frankly look at all the stocks right now in last 6 trading sessions, Dixon in a sense still has scope to catch up. It has still scope to catch up with the Canes and with the Surma. See, this entire pack is going to be hunting together. And growth, when it comes back into a large sector where you know that the size of opportunity is very large, always leads to re-rating. So Dixon was a halo stock immediately after COVID. Then it lost its mojo because of volatility in the numbers. But now the management is sounding confident, which is certainly going to go down very well with investors who in a sense have written off Dixon. So this, I think, if you ask me, could really be the next pot of gold. The problem is valuations. But if you're looking at 3 years out, what is looking expensive today will actually look cheap when you look back.
Okay, so I think you should take note of the fact that Nikunj said it's going to be a pot of gold when it comes to the sector as a whole. Let's move right on then and discuss the next newsmaker, and that's Metro Brands. It was a bit disappointing when it came out with its numbers. The higher ad spends, the Cravatex loss as well impacted a bit. Of course, we'll be speaking with the management later to get it in a little more perspective. But Metro Brands, your views?
Markets knew that this has been a tough quarter for consumption. Yeah. Now, one side is luxury, and Metro Brand is not luxury in my book. It is actually semi-luxury. I mean, the luxury category in India is very different than what Metro Brand represents. It's a fantastically run company. Because the P multiple of Metro Brands is high, in the near term, it will lead to re-rating. But on a 15-20% decline, you want to go back to a company like Metro Brands. Maybe not today, but maybe on a bad decline, a bad patch of the market when there is a rainy season, literally speaking for the market, not for Mumbai monsoon, that's the time you want to buy into some of these stocks. I think the word valuation in a company like Metro Brands should be ignored because these are businesses which have a very long, runway, so to speak. Their their focus on cost management, I think, is very efficient. This brand is built and it's here to last. We've seen an extraordinary rally in some of the footwear stocks same time last year. I think that kind of a rally is unlikely to make a comeback. But let's say on a bad patch, 750, 725, 820, 700, that's the time you definitely want to be a buyer in metro bands.
Okay, so Nikunj giving his technical expertise also there. Those are the stocks, Aisha, on the editor's radar.
Oh, yeah, absolutely. We just chatted with the Dixon Technologies management and they're pretty gung-ho about business and how it's going to be in FY24, especially the mobile segment, which they foresee is going to contribute over 50% or rather around 50% to the total revenue mix pie. And they're saying that the mobile segment is going to double in revenues in FY24. So that's Dixon Technologies. Rahul, just wanted your own perspective on how this Make in India within the electrical segment story is going to pan out and whether these stocks could be what perhaps railways and defense were a year and a half back.
I think if you look at the Dixon Technologies performance, I think post-listing the stock has done a blockbuster, but obviously as Nikunj was pointing out that I think the valuation remains a challenge. But if you look at in terms of market cap, then it looks cheaper than I think a few players on a listed space where if some investor wants to, these are the high growth companies and where we see. So my sense is I think still, but if you want to create some kind of an allocation in a portfolio, I think where you have very limited choice in this segment. And so I think Dixon is a prominent player into it. So I would say that I think one should have small allocation definitely in the portfolio. But yes, your valuation will always remain challenged for the high growth companies. Vis-a-vis, there are other listed players as well. But I think also that Ember Enterprise also looks interesting if I have to compare with Dixon and so I think both looks good. Ember and Dixon should be a part of the portfolio. That is what looks like from here.
DVs, good old DVs. Nooresh, good old DVs. Has it corrected enough? Has it come back enough? Do you think this is now more like a level at which you should revisit DVs?
So it is still in a question mark because the only difference we've seen over the last 1 year is in the last 1 year, every time there was a quarterly result, the stock saw a 15% drop. This continued for at least 4 quarters. And now finally this quarter, we've not seen a similar decline. We are seeing an uptick. We recently saw a downtick also from the 34.50 mark, which was a resistance, but in the last 2 days, it has come back. Now, the resistance to watch out for is over the last 6 months, 35.50 has been the top. If that breaks on the upside, that would indicate a reversal. But seems difficult because that was a level which was an earlier support back in 2022. So I would expect a lot of resistance around 35.50. So for now, I would expect it to consolidate, make some more time. But the first indications in terms of the bottom being in place is the fact that we've not seen a sharp decline post-quarterly numbers. But can we break out from 3,500 to 4,000, 4,400 looks difficult. So for now, I would wait for some more time, let it consolidate here and then maybe take a fresh look.
So what are superstar investors betting on? We've had Sunil and we've had Prashant on ET Now this week, and both of them are excited about banks. They feel India has a long way to go in terms. Indian markets have a long way to go. The house is divided on why Prashant is not very excited about buying consumer discretionary, but Sunil feels that's a go-to space given that India's per capita income is zooming higher.
So I think from an India perspective, whether you get opportunities to invest directly in EV plays or not, I don't know. But indirect benefit to the economy is going to be huge. And I think over a period of time, as the segment becomes bigger, we have already started seeing Teslas of the world looking at setting a base in India. And when that happens, I think even if no direct play, there will be a lot of indirect plays which will be available over a period of time. So it's still early days. There are a few auto companies who are trying to make their mark on the EV space. But I think over a period of time, we'll get an opportunity. Our view on particularly, generally metals, but steel is quite constructive. Yes, last 2-3 months, nothing has happened even in China. But our view on steel is very constructive. I think the last 2-3 years of bumper profits has enabled most of these companies to be having great balance sheets. As and when the demand picks up globally, I think this is one sector which will surprise.
There could be still some scope for it to get re-rated is the power sector. Because go back 2 years and ESG was a very live theme, and the world thought that you can transition from conventional to new energy overnight. And we have discussed this number of time, that was not a very realistic view. But I think people have come around to that view that conventional power is here to stay. In barring the electronics space, where we are yet to create an ecosystem, and we are essentially assemblers right now. But I think barring that, our ecosystem is also reasonably well developed. So I would say whether it is textiles, whether it is engineering goods, whether it is chemicals, pharmaceuticals, in all these spaces, whether it is automobiles. Look at what Mr. Bhargava said recently. He said new plant dedicated towards exports. In two-wheelers we have done extremely well. So I think all spaces of manufacturing by and large, other than electronics, I think we have reasonable capability and we should do quite well, and we are moving in that direction.
Okay, meantime, yesterday's chart saw the likes of a Delta Corp really flare up. Wanted to get in your thoughts, Kunal, on this stock as well as what the outlook is on Bandhan Bank. Both stocks I think that you track quite closely, if I'm not mistaken.
So yeah, Delta Corp is interesting because and for a positive surprise, the stock has not gone into the F&O ban, which has been a very nagging concern for Delta Corp over the last so many months. There have been multiple times that the stock had come back towards 220, 230, but the moment it used to enter into that trading range, the stock used to get back into a deep F&O ban. So I think that's generally not happened this time around for Delta Corp, and I think that's where you've not seen the stock going into a selling pressure or unwinding of positions all of a sudden. So that's why the move is sustaining for Delta Corp. Looks interesting, and I believe that till the time we don't see that phenomena occurring for Delta Corp over the near term, 220, which was the previous resistance, could now act as a good base for the stock price. So traders who've been buying or holding on to long positions, I think could continue to do that, and 220 could be a trailing stop loss. For Bandhan Bank also, I think it's been one of the very strong recovery from the private sector banking names in the last 2-3 months. So the stock had recovered from 200 or 205 odd levels to 250 plus marks, so a 20% plus recovery in a span of the last 1.5 odd month. And majority of it, the initial move at least was more of short covering, and then the move started to get a bit more stable for Bandhan Banks, and that generally indicates that there has been long built up, long formations which have happened into the stock price. So again, a good chart, interesting pickup. The stock is significantly below its all-time high levels, which means if there is a potential up move for the banking index, then I think Bandhan Bank, maybe RBL Bank and such other mid-cap high beta names, they can also stand to outperform.
Okay, fair enough. Meantime, Rahul, just looking at the entire consumption gamut, and we were talking about how, yes, there has been a slowdown of sorts. If you had to pick and choose within the entire consumption space, betting on the rural theme as well, some strong players that look good for the long haul, what would they be? Rahul, you're on mute. Just unmute yourself.
So when you talk about the consumer names, two, three trends which is quite visible. One is obviously the volumes have not moved up in terms of, it's been quarter on quarter, just marginally flat and marginal growth for a few companies here and there. But one more important thing to note is I think that because of the fall in the commodity prices, there could be a margin expansion from coming few quarters, and this will lead into the growth way. Secondly, I think if I have to talk about the companies which have delivered their numbers or which looks interesting from here, I think in FMCG space, I think one is Tata Consumer, which we like, and I think obviously the valuations for most of the FMCG companies have been expensive, and I think that's also one of the reason I think where the investors have been nervous giving this kind of a high P rate which they used to command. So, but I think where the transformation of this Tata Consumer is into 2-3 segments, improving their distribution network and launching a new products and segments as well. So I feel that again risk again on the rewards in entire FMCG play. I think this could be one of the better performers rather than others. There could be at least a 20% upside from this stock. So I think one should look at this stock in the FMCG space.
All right, there you have it. Those are some recommendations coming in on the FMCG space. Meantime, Nooresh, let's get in your thoughts then. Greaves Cotton, that stock declining in yesterday's trading session, and NCC was a big loser.
So Greaves Cotton is still technically shaping up for a reversal. The stock has gone through a correction from 250 levels all the way to 120. The recent move from 135 to 160 was on very large volumes. So that's an indication the bottom is in place. So it's a buy on dips to 140, 150 zone. Seems like the stock has made a bottom and slowly and steadily could go higher. So positive on Greaves Cotton, a buy on dips to 150 to 140 levels for now. NCC has seen a price action post the election results, but technically the last breakout was at 95 to 100 levels. So at 95, 98 levels would be actually this zone of 95 to 100 would be a good buying support area. From here, we could see a slow and steady recovery. So technically a retest of the last breakout. And this is the breakout where it got resisted multiple times, 2021 to 2023. There are 6 attempts around that 9500 mark. So this dip is a good opportunity, a good 20% correction from the top. Overall trend still remains positive. So looking at NCC as a buy at current levels.
Look at pharmaceuticals, and what's interesting here is that within the pharma space, stocks which are not on everyone's radar are the ones which have made a comeback. Aurobindo Pharma, Lupin, and stocks which are on everyone's radar, which is for example Cipla and Sun Pharma, they've underperformed. Kunal, ये क्या हो रहा है? Stocks which people don't like are the ones which have made a comeback in last 3 months.
Well, I would not say not like, but then some.
Aurobindo, Lupin, they were bombed out stocks.
Yeah, they were bombed out stocks. There was no trading activity. There was no interest towards the stock. So everyone was waiting for the reversal to happen, but that did not happen for a good part of.
Politically right when I say not everybody liked. Bombed out, no trading happening, no interest. What does that mean?
That generally implies.
What does that mean?
So not good and bad are two different implications.
Off the radar.
Yeah.
Stocks which were not on everyone's radar, they are the ones which have made a comeback.
Add to that 2 more names, Glenmark Pharma, Zydus Life. Biocon has made a very good comeback. That stock was, I think if I can put it, more despised in terms of trading because the stock used to just get into a sharp correction every now and then. DV Slab has made a phenomenal comeback from 2,700, 750 to I think 3,300 or 400. The stock closed yesterday. So a lot of the unusuals have made a good comeback this time around, and that's where the market texture is a lot more different to anticipate this time around. Even if we talk about the pharma sector overall, that it's not the usual ones which have made a comeback. Stocks like Glenmark Pharma, I think if I'm not wrong, 2 days back when it delivered results, the results were actually negative. The stock corrected to 580, and then in the next couple of days, it made a comeback towards 610, 620 levels. But that's not the case with all of those pharma names, at least over the last 1 or 2 months. So there's a decisive change of trend for many of the stocks. Even after a couple of days of bad results, these stocks have made a good comeback. But the ones which have been completely beaten down, the likes of Gland Pharma, the large cap names like Sun Pharma, Cipla, these stocks have underperformed quite significantly.
Nooresh, after this sharp readjustment in the pharma space where off the radar stocks are making a comeback, do you think pharma could be this outperforming sector for the second half of this year?
So pharma as a pack has been difficult to understand because every stock is in a different trend and we are not seeing sustainable trends. So we saw Dr. Reddy's breakout at 4,400, 4,500, went up higher and then flipped back on a single quarterly number. The stock is back to 4,400, 4,500. Sun Pharma started off in a big way, but it looks like a false start now, back into the sideways rut. So the larger names, nothing is happening. In smaller names, we are seeing a recovery, but a lot of these names had fallen quite a lot. So for example, if you look at Biocon, the stock went below March 2020 lows. You look at Aurobindo Pharma, the stock went almost, was available only 20% higher than March 20 lows. So that is where the recovery has been. So overall out here, every stock is in a different trend. Then you see a small cap like Newland Labs making new all-time highs, but a Laurus Labs is still down 60% from the top. So in this scenario, the case is one will have to take a stock by stock view. So Lupin in the near term has made a bottom. The stock is trending up higher. The stock went back almost to March 20 lows. It's still down from 2100 where it was in 2015. So overall, say from here, Lupin could look interesting, but the fact is the trend has been terrible over the last 2 years and over the last 7 years as well. So one has to be opportunistic, one has to be stock specific rather than take a whole sectoral call, because the large heavyweights are not making any moves. So the pharma index would not show the moves which are happening underneath in some smaller names.
Adani stocks, which is the strongest one would you buy? Because this is raging momentum, and for the trader, the momentum is important. Directionally, which is one Adani stock you happy to buy at 9:15 today? Only one stock.
There'll still be Ambuja Cement. So if given choice of two, then maybe Adani Ports and Ambuja Cement.
Only one.
So that's why if given choice of two, I'll pick up both of these stocks. I think that's where I've been most skewed towards. And out of the two names, I think Ambuja Cement is a lot more solid because the stock corrected quite least in comparison in the month of January end. And when the stock recovered, the recovery was more slow, gradual. In fact, the best part about the charts for Ambuja Cement is that I think the low the stock had made was around 315, if I'm not wrong, in the end of January. And from 315, when you try and draw very simple trend line support, it joins the exact lows for Ambuja Cement over the last 3-4 months, which means that the stock has been more of a staggered, a slow, gradual uptrend, and consistently moving up higher, low beta, less volatility, and I think all of those factors are very interesting for the stock. So that's what I would probably pick.
Okay, meantime, Rahul, wanted to get in your thoughts then on the capital goods space. On the one side, you've got Siemens, which is clearly getting a big thumbs down on the back of all of the news that's come in. Valuations, according to the market experts, aren't at par. And then there's L&T. Recently, they've reiterated their revenue growth guidance as well as their order flow guidance, saying that all of this is going to be achievable. Are you very selective when it comes to the capital goods space? Any particular stocks you'd like to?
I think when we talk about the capital goods sector, I think select few large names are available, and I think they've usually traded always on expensive. So we've never gotten a cheaper valuation. So if we have to select, if we have to get into names like Siemens or L&T or Cummins on that matter, and I think when we talk about select stocks, what we from here, I think all the three looks very interesting from my perspective. Obviously, Siemens have cooled down from the recent highs and all. Obviously, that looks interesting. Cummins remains our top bets for investments. And thirdly, I think L&T, I think you get a full-fledged investment overall bouquet, and I think L&T also offers well. So I think I would advise, I think the trends have been positive. We have seen the things coming back in the capital goods space. So I would advise buying all the three stocks for the portfolio.
Okay, pretty bullish on the entire capital goods space as a whole. Let's shift gears then and find out what the mid-cap strategies are from our charters. By the way, a quick glance at the pre-open ticks, and no surprises to see red on the screen owing to the kind of handover that we saw from Wall Street. So Kunal, what's your mid-cap call?
So that's a stock which I think I'd recommended a week and a half out back, Astra Micro, when the stock was at 315-16 levels. It's moved up to 345, 346 where it closed yesterday. Again, an interesting chart, a flag pattern breakout on the daily time frame. So would suggest a buy on Astra Micro even at current levels. 360 could be a revised target for traders who are looking at a fresh bet at current levels. Stop loss for this trade, 339.
Okay, there you have it. That's what Kunal is flagging off. Moving on then, Nooresh, what's standing out on the mid-cap charts?
So that would be a buy on Varroc Engineering with a stop loss at 300 and a target price of 360 plus. The stock yesterday saw a price volume jump up post the numbers. It has made a classical double bottom around 250 levels, gave a recovery, and the last 6 to 8 month high is around 310. Yesterday's closing was good about 310. A 5x volume, more than a 5x, 7x volume jump up, so that indicates price to volume action. So looking at it as a short-term trade for the next few sessions.
Okay, there you have it. Those are some interesting names that our chartists are flagging off. Moving on then, here are all the top headlines that we're tracking outside the world of business. All right, let's move on to the stocks on the editor's radar. Just revisit the two stocks that we discussed, Dixon Technologies and Metro Brands. Take a look.
2 years ago, what happens to defense manufacturing? 6 months ago, a year ago, what happened with railway manufacturing? I think next 1 year will happen with electronic manufacturing. They are talking about aggressive growth in FY24, and it's a very it's a low margin but a high turnover business. They did have a cyclicality in the business, and markets thought that the business is not linear, it is a cyclical business, but they are talking about that growth is actually making a comeback. Now, why do we have Dixon back? Because if you frankly look at all the stocks right now in last 6 trading sessions, Dixon in a sense still has scope to catch up. It has still scope to catch up with the Cairns and with the Sirma. See, this entire pack is going to be hunting together. And growth, when it comes back into a large sector where you know that the size of opportunity is very large, always leads to re-rating. So Dixon was a halo stock immediately after COVID. Then it lost its mojo because of volatility in the numbers. But now the management is sounding confident, which is certainly going to go down very well with the investors who, in a sense, have written off Dixon. So this, I think, if you ask me, could really be the next pot of gold. The problem is valuations. But if you're looking at 3 years out, what is looking expensive today will actually look cheap when you look back.
Okay, so I think you should take note of the fact that Nikunj said it's going to be a pot of gold when it comes to the sector as a whole. Let's move right on then and discuss the next newsmaker, and that's Metro Brands. It was a bit disappointing when it came out with its numbers. The higher ad spends, the Cravatex loss as well impacted a bit. Of course, we'll be speaking with the management later to get it in a little more perspective. But Metro Brands, your views?
You know, markets knew that this has been a tough quarter for consumption. Yeah. Now, one side is luxury, and Metro Brand is not luxury in my book. It is actually semi-luxury. I mean, the luxury category in India is very different than what Metro Brand represents. It's a fantastically run company. Because the P multiple of Metro Brands is high, in the near term, it will lead to re-rating. But on a 15-20% decline, you want to go back to a company like Metro Brands. Maybe not today, but maybe on a bad decline, a bad patch of the market when there is a rainy season, literally speaking, for the market, not for Mumbai monsoon. That's the time you want to buy into some of these stocks. I think the word valuation in a company like Metro Brands should be ignored because these are businesses which have a very long, runway, so to speak. Their focus on cost management, I think, is very efficient. This brand is built and it's here to last. We've seen an extraordinary rally in some of the footwear stocks same time last year. I think that kind of a rally is unlikely to make a comeback. But let's say on a bad patch, 750, 725, 820, 700, that's the time you definitely want to be a buyer in Metro Brands.
Okay, looking at a whole host of individual stocks that are going to be reacting to all the earnings this morning. In fact, let's look at what Dixon Technologies is doing, a stock that we just flagged off for you, and see how the earnings reaction is. Of course, you've got a slew of earnings lined up today as well, whole host of important liquid mid caps. There you go, 1.6% higher for Dixon. 33.30 is where this particular stock, and it is in yesterday as well, in the run-up to its numbers also, this was a gainer in over about 1% or so is the kind of gain that it saw yesterday. A lot of other stocks which also we're going to be keeping on our radar. So let's see what Nifty IT is up to, because the last 2 days it's taken a bit of a step back. But having said that, it seems to be part of a larger recovery that seems to be taking place within the entire IT pack. Barring Infosys, a whole host of mid caps and other large cap IT names as well have seen a recovery month to date so far and have been in the positive. But Kunal, individually, what is it that you're making of the IT recovery?
So I think it's led by more mid-cap names rather than the large-cap stocks. At least that was the texture for the IT index in the last 1 month. Specifically, remember, post the Infosys result, the IT index had opened with a sharp gap down. That gap was around 28,200 on the upside and 27,100 on the downside. So almost like an 800-900 point gap for the Nifty IT index. Finally, that gap has been filled and the IT index has managed to surpass the highs which were made just a couple of days prior to the Nifty results, which means that the last leg of recovery, at least over the last couple of days, there are a lot many large cap names which have added to the list. But I would still believe that the momentum, the breakout, and the leadership is actually into the mid cap IT index. So there are a lot of stocks which have performed exceptionally well. Cyient, Persistent, L&T, Infotech, Mindtree. These stocks have managed to surpass their previous resistances with a lot of ease this time around. So it's always better to bet with momentum names, and for the sector so far, it looks like mid cap IT is the one where there's a lot of momentum.
Okay, there you have it. Let's find out then what the outlook is by way of the index calls from our chartists this morning and what they are advising. Do remember, for the past many days, it's been a whole strategy on the frontline index. Today, it looks like majority is tilting towards that, though Kunal on the frontline index as well is saying a buy on dips. Remember, we're talking about how we've seen a weak handover on Wall Street, the fact that we are expecting it to be a fairly soft start back home. We could languish back to that tight range which we were confined to, so a hold seems to be the consensus call. A quick take on the Nifty Bank Index, and it's the same call. A buy on dips from Kunal. Our other two chartists believe that it's a hold recommendation on the Nifty Bank.
Nooresh, what will be that number or that trend which would tell you that, look, the summer rally is getting over?
So that would be the recent lows around 18,000, 18,050. Say the higher top, higher bottom breaking would be the first indication. So till the time we are above those levels of 18,000, 18,050, the trend still remains positive. So before that point, I would not be looking at a negative thing.
Well, there are two parts to the rally. One, there's a big turn from 16,800. That's the big trend. And within that, there are smaller trends. So what is that big trend number which, if it breaks or if that changes in terms of the trading landscape, you would say the summer rally is actually over?
So level-wise, 18,000, 18,050 is a support. I think we've tested this almost two or three times in the last 10 days. We've managed to protect that level, so that remains a support. But the indicator or the trend-wise, I think dollar index is the one which I believe holds a lot of significance, because I think just about a week or so, the dollar index was at 101 levels. That's where the market topped out at 18,450 levels. Now with the dollar index rising at 103.5 and being consistently above those levels, it's acting as a concern for emerging markets and especially our markets. We've seen that same phenomena happening in December 2022 when our markets topped out, and we've corrected some, I think, 1,500, 1,800 points from that 18,800 levels. That was also on the back of some rise in the dollar index. So that would be the only factor, I believe, which could probably play a spoil sport for the current market trend.
Nooresh, again, you mentioned this level of 18,000, but for the Bank Nifty, what would be the parallel?
So that would be a little lower comparatively, because that's an index which has done much better than the Nifty. So for now, I would keep a level around more, that would come much more lower at 42,500 to 42,600 mark. So that's quite a bit far off from the current levels. So a correction out there could be normal, because if you look at the previous highs, we were at 44,000 and we are still around those levels. So for now, the longer term trend or even the shorter term trend, major swing lows are at 42,500. Till that point of time, the banks continue to be interesting. It is very interesting that without HDFC Bank also, the Bank Nifty has gone up close to a new all-time high. And HDFC Bank is still 28% of the Bank Nifty.
Okay, whole host of other stocks as well which are going to be in focus, and Sun Pharma also on our radar this morning, considering Taro has come out with its numbers, and just very quickly they've improved their earnings on a sequential basis. Margins as well have seen an uptick of about 500 basis points, and that's likely to have a rub off on Sun Pharma, which is holding out in the green this morning. Ashok Leyland, we just chatted with the management as well. The margins have appreciated about almost 200 basis points on a year-on-year basis. The operating profits as well are above the estimates. So a lot of other stocks, Nikunj, in focus.
Yeah, it's just one of those days, Aisha, where I think you may just get pushed here and there, and you got an FNO expiry, so that will always add to this extra element of volatility. Look, for someone who's a hand-on heart trader, the number which matters is 18,000 for the Nifty. The second number which matters, or the second data which matters, is the FI flows, which have been strong and robust. The third thing is the dollar index. I think as long as you've got these three things favorable, this market may just, get pushed here and there, but there would be no decisive break to the trend. Within the mid-cap space, I think there is a comeback which is there in some of the electronic stocks. There is a comeback which should happen in some of the niche consumer names. And there is a comeback which I think is happening in some of the mid-tier banks, because large banks in a sense have done their bit in this early part of the rally. So these are three groups which in my book actually would be important. First rates, Wednesday morning, on your screen, they will just start popping up, and you've got a cut of 50 points on the Nifty, and then in line with what SGX was indicating. And for the index per se, it's an even Steven market breadth. So we are off to a great start. The breadth is weak, markets are weak. Adani group of stocks, they continue irrespective of what is happening in the world, because they are in a unique position in terms of where the momentum and where the positioning is. So Adani group of stocks, they continue to flare selectively, not all of them actually. Adani Enterprises is the one which is flaring up, Ports is flaring up, Adani Transmission locked up, Adani Green should be locked up, Adani Wilmer also, I don't think there is energy for change per se. Some numbers which are important: number one is Metro, second is Dixon, third I would say BKG, and fourth I would say Fortis. These are four numbers which from the mid-cap space are going to be important. Metro down, Dixon up, BKG Foods up 10 rupees, and then you've got Fortis where numbers are in line but margin expansion has been decent, and the stock reaction on the screen 290.
Right. Let's see what Sun Pharma is doing right now, what the Adani group of stocks are up to, Adani Enterprises, Adani Ports, Ambuja Cement, Wilmar. The entire pack is still seeing a bit of a follow through. Of course, the gains are a lot less than what we had the last three trading sessions. Biocon as well came out with a good set of numbers. The numbers have managed to post a beat. The EBITDA has seen an uptick of nearly 68.5%. A big move on Biocon this morning. Over 5% is the kind of surge that you're seeing on the stock price. NMDC as well, the results were largely above estimates. The Q4 sales volumes as well have come in higher. Ashok Leyland, Dixon Technologies, they're all reacting to their numbers this morning. NMDC though is a little bit quiet. So is Ashok Leyland, down about 0.6%. Dixon higher by 0.5% as we speak. Varroc Beverages, that's the other stock which is in news this morning. They've incorporated a company in South Africa to explore manufacturing and distribution of their businesses. Varroc Beverages 1.5% higher. Fortis, Amara Raja, they all came out with with decent set of numbers. We're going to be chatting with the Fortis management as well, although Amara Raja is down 1%. But the margins have seen an uptick of about 380 basis points. And for Fortis as well, the net profit has jumped up 59% on a year-on-year basis. Let's see what the other earnings reactions are with JSW Energy, which has not been the best of set. There's Metro Brands as well, which came out with its numbers. We just flagged that off as well. Let's see what Metro Brands is up to. A gap down, 4.5% lower for Metro as we speak. Sequin, Galaxy Surfactants, these are all numbers which came out yesterday post-market hours. So let's see where the Nifty is finally settling in at. Marginally soft. The future still holding on to 18,300. Biocon, Adani Enterprises, Manappuram, these are your big star performers. Having said that, one of your biggest drags also within the liquid universe is Adani Ports, 1.5% lower there. Kunal, what do you make of trades so far and any trades that you're punching in?
Yeah, so I think we're back at 18,400 as a range for the index. So I think we are almost at 18,300 levels, which means we are more or less there within the range. The sector trend which we need to watch out for is whether there is unwinding of large cap IT names as well as push towards the PSU banking stocks or the private sector banking names or not. Now, the stock which I would look to initiate would be Bank of Baroda. I believe that the stock has made a good comeback in the last couple of days, bouncing up from 176.78 to 180, 182 very close yesterday. So that's a stock which looks interesting on the charts.
Nooresh, let's get in a quick call as to what you're looking at as your first trade this morning.
So staying a little defensive, continued like ICICI Bank, that's a stock on dip today at 940, 945 would be interesting buy. Overall, looking at it to cross the 52-week highs around 960 mark and slowly go towards 1,000, 1,050 levels. So ICICI Bank is the one which looks interesting.